if you're going the direction of Bitcoin and from a corporate perspective, putting Bitcoin on the balance sheet and amplifying it, that is likely to produce better returns than really focusing on cash flowing businesses. If you believe that Bitcoin's going to go up 30% plus per year. Now, if you don't believe that, then maybe the cash flow business and focusing in that direction is a better way to maximize returns. But if Bitcoin's going up to the right, it's very hard to beat Bitcoin as a hurdle rate. And so my background being asset management, I always think in hurdle rates. And so like when I was at CalPERS, my hurdle rate was a bond index, the Bloomberg Ag. So every decision I made had to beat that hurdle rate. And for us, if we're setting Bitcoin as a hurdle rate, frankly, it's just a very hard hurdle rate to beat over the long run. And so we look at ways to amplify Bitcoin exposure that are only available to corporations. They're not available to us as individuals or to hedge funds. And then take that long-term view. And for the next 10, 20 years, our view is just amplified Bitcoin is probably going to be almost impossible to beat if our bull thesis on Bitcoin plays out.
Bitcoin is down. You knew this. But did you know that every Bitcoin Treasury company is down? Surely not all of them are going to survive. I've got Matt Cole, the CEO of Strive, on the pod today. He explains that Strive is structured to survive events like this. This is a really interesting conversation. Hope you enjoy. Welcome back to the Blockspace podcast. I've got Matt Cole, chairman and CEO of Strive, Bitcoin Treasury company. Matt, welcome to the podcast.
Thanks for having me. Excited for the conversation today.
Yeah, and today, we're recording this on Friday, the morning of Friday, November 21st. Bitcoin's down. I'll just throw it right at you. What is the vibe inside of Strive right now with Bitcoin pulling back, like 30%? How are you guys feeling?
Yeah, so we are long-term investors. And so we have a structural, call it 4 to 15-year structurally bullish thesis of Bitcoin, where we think the average return over the next 10 to 15 years will average over 30% with very high volatility. And so we expect drawdowns. Drawdowns could be 30%, 40%, 50%, 60%. My base case is that the days of 80% drawdowns are probably behind us at this point, but 50% drawdowns, absolutely not. I mean, that's part of the game that we play. And as longtime Bitcoiners, you know that it's actually that volatility that creates the opportunity to get the higher returns of Bitcoin as monetary debasement continues. And I think one of our strongest held beliefs is that they're never going to stop printing money, that the debt crisis will not be fixed. And if anything, earlier this year when Doge started, that was probably the best chance the United States was going to have to actually fix the fiscal situation, and it fell apart within a month or two. And so, I think these types of sell-offs are expected. What's never expected is exactly when they're going to happen. That is not the game that we try to play. We don't try to forecast that. We don't know that. We always approach things from the perspective of, on average, Bitcoin will go up 30% plus per year. So every time we have a decision, we approach it with that in mind, not a decision of what do we think Bitcoin is going to do over the next 1 month, 2 months, or 3 months. And so that's filtered into many things that we might touch on today, including how we've approached amplifying Bitcoin exposure, where we have a preferred equity. There's no margin requirements. We could literally ride Bitcoin to $1. And like Sailor says, if it goes to $1, we'll just buy all the Bitcoin. Ultimately, what we need is over the course of 5 to 15 years, our structural bull thesis to play out. And we can, in the meantime, ride out any volatility.
We will dive into each of those points you made, but I want to roll back, zoom really far out, and acknowledge that the Bitcoin Treasury play is, it's not new, but it is really hot as of this spring and summer. What led you personally down this path into this game? Why did you decide to go into the Bitcoin Treasury game and lead Strive?
It starts with the fact that I have basically had my entire net worth in Bitcoin since late 2016, early 2017. I wish it was earlier, but that's when I finally realized it wasn't a scam and became, like many Bitcoiners, so structurally bullish. I just felt so short the asset and I couldn't get enough of it. So that was my own personal investing thesis. And For Strive, we're an asset manager. We have 13 ETFs, about $2 billion of AUM. And our core mission was about pushing back against ESG and DEI and back towards capitalism. And that viewpoint, when we launched in 2022, we were co-founded by Vivek Ramaswamy. That was a very contrarian viewpoint. And late last year, it started to become more of a consensus viewpoint. Not that every issue that we talked about was solved, but when your core differentiation goes from contrarian to consensus substantially faster than you would expect, you have to think about, how do I maximize value for our company in a way that is true to myself as the CEO, our co-founder Vivek, who is now a Bitcoiner. And I played a small part in orange pilling him over the last couple of years. And he was the first presidential candidate in 2024 when he first to speak at a Bitcoin conference. And so he became orange pilled over the last couple of years. And so we saw a massive opportunity to pivot the company in the Bitcoin direction. So we were exploring the best way to do that, having many conversations. And one of those conversations, or some of those conversations, because it was more than one, was with Michael Saylor. And he really orange pilled us on, if you're going the direction of Bitcoin from a corporate perspective, putting Bitcoin on the balance sheet and amplifying it, that is likely to produce better returns than really focusing on cash flowing businesses. If you believe that Bitcoin's going to go up 30% plus per year. Now, if you don't believe that, then maybe the cash flow business and focusing in that direction is a better way to maximize returns. But if Bitcoin's going up to the right, it's very hard to beat Bitcoin as a hurdle rate, which is why we talked a little bit before we started recording. We have a podcast called The Hurdle Rate, and so my background being asset management, I always think in hurdle rates. And so like when I was at CalPERS, my hurdle rate was a bond index, the Bloomberg Ag. So every decision I made had to beat that hurdle rate. And for us, if we're setting Bitcoin as a hurdle rate, frankly, it's just a very hard hurdle rate to beat over the long run. And so we look at ways to amplify Bitcoin exposure that are only available to corporations. They're not available to us as individuals or to hedge funds. And then take that long-term view. And we are an operating company. And so over time, we will look to always maximize value. But for the next 10, 20 years, our view is just amplified Bitcoin is probably going to be almost impossible to beat if our bull thesis on Bitcoin plays out.
Yeah, in my cursory kind of like looking around of where a lot of these terms that define the Bitcoin Treasury discourse come from, hurdle rate, amplified Bitcoin. It seems that you've kind of been the one popularizing those, which is pretty interesting. You named the podcast after it. This may, again, kind of a foundational question, but I feel it is actually a bit existential right now, which is, what makes a Bitcoin Treasury company a good Bitcoin Treasury company? I think, with a lot of everybody being drawn down right now, there's a lot of, existential reflection saying, what of these is actually a good play? What are your thoughts?
Yeah. So let's really zoom out for a second. So, and I'll use the analogy of an individual. Is buying Bitcoin a good decision? If you're a Bitcoin bull, the answer is just yes, right? And so for companies to consider putting Bitcoin on their balance sheet, is that a good decision or a bad decision? If you're bullish Bitcoin, the likely answer is yes. But it being a good decision for the company does not necessarily mean that the company should trade at some massive premium to the Bitcoin holdings, right? That those are actually two different things. And so I'm very bullish on companies putting Bitcoin on their balance sheet, that Bitcoin is a savings vehicle, and that if you are able to save in Bitcoin, whether you're an individual, whether you're a company, whether you're a nation, that's likely a good decision. Okay. Now the next question becomes, how do you think about valuing the Bitcoin? Well, if you're a company and you're just putting Bitcoin on the balance sheet, you're not trying to amplify its returns, you're not really doing anything unique, the value of the Bitcoin is probably the value of the Bitcoin. Like that's like very simplistically, like that's probably the answer. And for a company, if Bitcoin goes up 30% a year, that's a very good thing for that business. Like it's not a bad thing. But the question becomes, when and how should you think about a company being worth more than the value of the Bitcoin, right? And what that comes down to is like structural uniqueness and rarity that in a form that could actually outperform Bitcoin itself over the long run, right? When some of these terms, just to be fair, I don't think I popularized. I do think that we popularized the hurdle rate with Bitcoin. Amplification, I'll give full credit to Saylor, but I think it's a great term, which we can get into of the difference between leverage and amplification, because that to some people will just be like, sounds like a fluffy corporate term that you're just trying to redefine things. But the reality is that it's very important actually, because the preferred equity is not debt. And that becomes very important when we talk about the risks, because you'll never hear me say that Bitcoin treasury companies have no risk. They're actually amplified Bitcoin exposure. So they're amplifying the Bitcoin risk, right? And my belief, I'm so bullish on Bitcoin that I think it's very hard to see a scenario where it doesn't fail, but it has volatility, right? And you're amplifying a volatile asset, right? And that could be scary to some. So that's kind of the high level. And so for Strive as an example, why do I think that? So we trade at a premium to our Bitcoin holdings. We're actually, I would say in the industry, most companies, Bitcoin treasury companies today probably trade at a discount.
Yeah, everybody's at a discount right now.
Yeah, and we're trading at a premium. Strategies trading at a premium. I actually think that valuations are pretty compressed, and that there's other companies that are currently trading at a discount that should trade at a premium. There's some that I don't think, without naming particular names. But I think the question becomes: are you doing something unique? Do you have an advantage? Like, can someone just copy you in 3 months? And with Strive, we're in a position where effectively no one can even copy us for the next several years. So our corporate structure, so we have no debt. We have amplification through our preferred equity. So it's not leverage, but you could think about it as levered exposure to Bitcoin, around 25 to 30%, depending on where Bitcoin is at the moment. And we are where strategy itself wants to be from a corporate perspective. They want to get to where we are in like 2028, 2029. And so we're in 2025. Right. So in 3 to 4 years, they're trying to get to our corporate structure. That is a unique differentiation. I'm very bullish on strategy too, just to be clear, but that is different. Right. And other players, they have already taken on debt. They don't have enough Bitcoin. They don't have the team to actually IPO a security like that. And so there will not be other players that have the same capital structure as Strive. The closest example would be Metaplanet, but even there, they're taking a different approach to us. And so we have a unique capital structure that you as an individual cannot get amplification in the way that we got. You could go on, great platforms, by the way, like you could go on Strike, you could borrow Bitcoin. I think it's a great, or borrow against your Bitcoin. I think it's a great product. But if Bitcoin goes down, you could be liquidated. So it's not that I'm against the product. It's just that I think that our risk profile is actually superior, and that superior risk profile demands a premium. What is the correct premium? Well, I think it depends on, I think the correct premium that it will be attractive to you will depend on your own assessment of what you think Bitcoin does in the future. And so there's this concept that strategy came up with that we also are using called Bitcoin factor. And so it allows you as an individual to say, what do I think the potential future returns of Bitcoin are? Like I've told you, our base case is 30%. Your base case could be something completely different. It could be lower, it could be higher. You might have a range that you're thinking in. And then you could do the math and say, with that amplification over 10 years, how much, multiple of my Bitcoin holdings could Strive drive if that thesis plays out. And you say, okay, well, those are the, and remember, that's only one way. We have other ways that we can also add, accretive Bitcoin, like acquisitions, what we're doing with Semler, like using the ATM at times. And then you could say, what's a fair value of that as an investor? Like probably some discount to that, right? Like you're not going to pay the full value of what you would expect a company to invest. That would be fully valued. There's some discount to that is the appropriate MNAV that would be multiple Bitcoin holdings that would likely be attractive to you as a Bitcoin bull. And obviously, if you're not a Bitcoin bull, then there's no thesis to invest in a Bitcoin treasury company.
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds You can find him on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like The Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin.
You mentioned it's like this preferred structure is I don't know if it's the secret sauce, but it's very attractive. Looks brilliant right now. And you mentioned that like no one can copy you right now, or like MicroStrategy or strategy wants to be where you are in 2028. Maybe this is an obvious question. People more familiar with the mechanics of TradFi and public companies, but why? Like, why does it take MSTR like 2-3 more years to get to where you are? Maybe handhold me through this, because I actually don't know why. I cover the world where like, I look at the various blockchains. Like, you could launch a token immediately. Why does traditional finance? Why do traditional corporations? Why does that take so long to evolve towards that?
Yeah. So in traditional finance, moving in 2, 3, 4 year periods is actually very quick. In coming from a pension fund, I mean, it would take probably 2 years to even come up with a roadmap, and then 10 years to execute on the roadmap. When I was there in like at CalPERS in like 2013, 2014, we were still using Excel 2003. So just to give you like examples of...
It's a good version of Excel, by the way. I'll say that.
Great.
So,
this is great. And by the way, I don't know if you saw this, but Satya Nadella had an awesome sweatshirt that he was rocking that said, "Making sheet happen since 1985." Made me laugh as an Excel nerd. But anyway, so why would it take strategy several years to get to the corporate structure that we want to get to? There's really 2 reasons. One, they have a handful of convertible notes. So they have debt that matures over the next few years. And so that takes time to mature. So they want to get to a debt-free structure. They have existing debt. So that is, I would say it's not a problem as in, I think they're under levered or under amplified. So like not as a problem as in like there's a risk of them blowing up, but just in retiring that. And then is going to take a few years. And then secondarily, they want to get to, call it 30% amplification, which is basically right where we are today, through preferred equity only. Now, strategy, their Bitcoin holdings is, call it $60 billion. Obviously, it fluctuates with Bitcoin. I don't know exactly where it is today, but let's just say it's 60 billion. And you want to have 30% amplification through preferred equity. And let's say they have 10%, just using round numbers today. Okay. That they need to have, call it 30% of 60 billion. So they need 18 billion of preferred equity. They have, let's say, 6 today. They need to go out there and raise $12 billion additional of preferred equity. The preferred equity markets are not that big. And so you're seeing them issue new preferreds. So they have 4 preferreds in the United States. They just issued Stream in Europe. It was their first one internationally. And so over the next few years, they, on one hand, need to retire their debt. And then on the other hand, go and find $12 billion of demand for preferred equity to get to 30% amplification. It actually is a lot of work. And there's a lot of education that needs to happen. I mean, we're going to play a part of that education with them, because we do think that the interest rate paid is actually mispriced. The risk is mispriced on these things. And so, we want to be part of the solution in helping build out the digital credit markets. But that's going to take a few years. I mean, the 2028, 2029 timeline is actually just what they publicly announced of when they expect their convertible notes to retire. Okay. So that's one hand. And then I'm assuming that they're going to be able to sell $12 billion of preferred equity. Now, and importantly, $12 billion assumes Bitcoin's at current prices. If Bitcoin doubles, well, now they need to sell, another 18 on top of the total. Now they need to sell $30 billion of preferred equity. And so their size is a strength when it comes to remaining in business, but it's actually a weakness in regards to getting the amplification that they want. So that's strategy. Then you look at the other players in the space, and almost all of them are too small and they have debt already. And so what we learned in IPOing SETA a few weeks ago is that for most institutions, a $200 million raise is kind of like the minimum that they want to see to get interest. And then, so that's on one hand. And then on the second hand, they also don't want to see, at least at IPO, more than 25% leverage or amplification. Okay. So what you need is, after the raise, you need to hold $800 million of Bitcoin, no debt, to be able to do this. You look down the list of Bitcoin companies, they all have debt and they don't have enough Bitcoin. And so they're just not in a position to IPO preferred equity like Strive has. And so I think that's the challenge for them. And so, I think what you're seeing in the space is many focusing in different areas. And I'm actually still very bullish on a lot of the Bitcoin Treasury companies outside of us and succeeding. I just think we're in a unique position to drive a differentiated risk and return profile that others will struggle to replicate.
So as I understand about like public markets, a lot of what drives public markets is like how well Wall Street understands what you are, especially for like the new type of companies, if we want to call Bitcoin Treasury companies, like a new breed of equity. What does Wall Street, what are like investors not understand or misunderstand about the Bitcoin Treasury strategy? Maybe just Strive's particular strategy. Like what are you having to like try to communicate to them?
Several things. And so I'll give you an example. It's actually an example about strategy, but it will apply to Strive as well. So S&P rated the debt of Strategy recently, and they gave Strategy a B- rating. And then importantly, they noted that they gave them zero credit for the Bitcoin on their balance sheet. Now, that's ridiculous. You can be a Bitcoin skeptic. You can think it doesn't deserve the full credit because of the volatility profile, but the fact that they have an asset worth $60 billion, it improves their credit worthiness, right? Like, would you feel better lending money to Strategy with $60 billion of Bitcoin or zero? Like, clearly you'd rather lend to the company with $60 billion of Bitcoin than zero, but they just ignored that, right? And so it's because Bitcoin is such a new novel asset to Wall Street that the rating agencies are just not at the point yet where they're going to give it credit. And so, that's an easy example to see how the ratings are too low. So the risk assessed to these companies are too high right now, right? And so whenever there's a disconnect to that degree, typically the best way to solve the problem is innovation. And so I think we need a company to actually come out and provide ratings to Bitcoin companies that are, fair, that take into account that, like, look, at some of these companies might have some liabilities in dollar terms and they own Bitcoin. And so as much as we are all Bitcoin bulls, like, that disconnect is both an opportunity, but also a risk to the person that has to get paid back in Bitcoin. And so, you should assess that. But I view MicroStrategy or Strategy as basically the most credit-worthy issuer in the world. I mean, they have such a large balance sheet in Bitcoin. I would feel better lending to them than almost any corporate that's facing massive AI risk right now. But that's not priced in. And so that's something we have to explain. We also have to explain, frankly, the difference between Bitcoin and all other cryptocurrencies, because a lot of Wall Street tends to actually more lump them together more than you would think that they should. I think that's fueled the digital asset treasury craze beyond just Bitcoin. You're seeing it in ETF space. And so, there should be a massive difference in assumed risk profile between Bitcoin and other securities. But I don't think that we are there yet with Wall Street. And so that's part of the education. I would say another part is just the fact that these companies are actually operating companies. And so Saylor is digitizing credit out into the market. He's creating massive products, solutions to retirees that want income. It's an operating business, but some of the index funds are debating whether they should have them in the indexes or not. And so there's really a need for education all around. And it's not a it's not a, it's a strategy to have a large balance sheet. Throughout history, many operating companies have decided to have a large balance sheet. And obviously we are already Bitcoin bulls, but I'll just tell you that even if I took out the Bitcoin bull thesis for a second, I would still want today as an operating company a large balance sheet. We're going through a massive disruption phase with AI. Obviously, we have monetary debasement. So having a hard asset, so like let's say cryptocurrency and Bitcoin didn't even exist, but we still had monetary debasement. We still had AI risk. I would say companies should be loading up on gold. Like you should be trying to opt out from the system. Now, Bitcoin is just a better form of investment. It's substantially better in every way than gold. But like if it didn't exist, like there would still be a need for large balance sheet companies. And so anyways, I think those are a lot of the different misconceptions. And I guess the last one is just understanding the difference between a balance sheet company and a company that's more focused on operating cash flows. And you could think about this, and I think the best way to think about this is actually to bring it back to like the individual and think about like you or your friend as an individual and say, and compare two people. One person that maybe has $1 million in their bank account and they don't work, and you wanted to let them borrow $10,000. The other person has a job, but they have no money in the savings account. Maybe they make $100,000 a year. Who would you rather lend $10,000 to? Most people would probably say the person with $1 million in the bank account. Like,
they have the cash already. I don't have to bank that they keep their job.
Yeah. So all those things are part of the, the learning that we are educating Wall Street on. Yeah.
You mentioned, because you actually mentioned this on I believe maybe the Hurdle Rate podcast, you mentioned like the opportunity and the huge market like dislocation for like a credit rating agency that takes into account this reality. It's kind of ridiculous that MicroStrategy doesn't get credit for its $60 billion, maybe a few billion less today, but still billions of dollars on their balance sheet. I'm curious about this. Like, what does that credit agency look like? I know that like you guys can't start one, but like, what do you think that type of company should look like? What would you be looking for if you were a credit rating agency and looking at like considering the Bitcoin dimension of these companies?
Yeah, so I would be looking at I would be running Monte Carlo simulations. I would basically allow people to write their own journey with regards to Bitcoin, and you could probably even assume like let's say, so as a rating agency, you're trying to be neutral, right? Like you're not trying to tell the equity story for a company. You're trying to say, how bad could things get? What are the likelihood that things get that bad, and what happens in that scenario for the credit, right? And so you would be taking a glass half empty approach to these companies. And you would be underwriting their risk with the glass half empty approach, which I much prefer to view the world glass half full. But as a credit investor, that's how you have to view the world. And then you would be running Monte Carlo simulations, so like thousands of scenarios with different volatility assumptions, different return assumptions, and say, of those thousands and thousands of scenarios, what are the likelihood that they're not able to meet their liabilities? And if they're not able to meet their liabilities, what is an assumed recovery for the credit investor, right? And what you'll see is that as long as you think that Bitcoin is going to go up, so you could even be very pessimistic. So I think Strategy put out something that said that they need Bitcoin to go up like 1.25% to meet their interest obligations, over the long run. Strive with our cost structure would be slightly higher than that, but like, single digits, call it maybe 4 or 5%, something like that. And say, okay, like how confident am I that over the next 10 years, Bitcoin's going to go up at all? And if I'm confident that it's going to go up at all, then you can quickly become very confident in them being creditworthy. Then the next question becomes, as an equity investor, so that's the That's the credit rating side. It's actually pretty simple. And then for the amplification to actually work and for strategy or Strive to outperform Bitcoin, you're going to probably want a little bit higher of a return assumption to feel pretty confident in that, but it's not actually that high. Like somewhere between 10 and 20% return assumption, you can feel pretty confident that there's a structural ability for them to outperform and Strive to outperform Bitcoin.
So I want to touch a little bit on the kind of ideological genesis of Strive. You mentioned it's kind of this like anti-ESG, pro-American capitalism, American exceptionalism view. Background, I spent some time in oil and gas. I'm in Oklahoma, very energy heavy. And I'm kind of curious because obviously it's now cool to be anti-ESG, but like it, or at least in many sectors, but not everywhere. I'm kind of curious, like, okay, if ESG is dead, what should replace it? And then which, in your mind, which sectors of the American economy are probably still most captured by this ESG anti-growth mindset? What are your thoughts?
Yeah, I would say 2 years ago, the clear sector that was the most constrained by the ESG movement was oil and gas.
Yep.
It literally, the way we were describing things was, that in the early shale boom, that there was probably some overinvestment. So not ESG constraints, but actually call it like overinvestment that wasn't smart. And then it fell apart. And then the ESG movement kind of put its boot on the neck of the oil and gas industry, kind of kicked it while it was down and substantially constrained it, right? And so some of the stories, it would be easier to just say it was just ESG from the start. It was the only thing, and but there was probably some bad investments in there that made it a weaker target. But you were seeing crazy things. So you were seeing like explicit statements from large asset managers trying to get oil and gas companies to basically wind down their operations by 2050. Things like, and then you would see very just like things that didn't even make the environment cleaner. So there was an example of Chevron selling something for ESG purposes, but then a Chinese company bought it. And so you say, okay, like now Chevron is emitting less into the atmosphere, but this was a profitable project. And now a Chinese company is operating it. Do you think that the Chinese company is going to be more or less likely to pollute more with that same property? It's like probably going to actually increase net pollution into the United States, but Chevron's not doing it. So, BlackRock or State Street or Vanguard could say we've done some good for the nation, and it just made no sense. And so, we saw pretty early that there was going to effectively be near unlimited demand for energy, and I think that I would say we were off, and that there's even more demand than we were expecting there to be.
Unlimited demand, yeah.
Yes. And so, but we were directionally right versus the industry that was calling for something different, right? And so this is not hard. I mean, you see graphs that basically are almost a perfectly straight line, that the more energy a country has, the more prosperous it is. And so that was part of what we were pushing for. We were also pushing for just nuclear energy, which was interesting because the ESG movement in its early days, and I think it's starting to change because we were hammering this, was anti-nuclear. And it was like nuclear is the cleanest source of energy that you could possibly find. It's also the most efficient, but yet the ESG movement was against it. And so it was really this anti-growth mindset. And so that was a lot of what we stood against. But we were also, I would say we were honest shooters. And there's many things in America that moves away from a pure capitalist society. We were, unapologetically standing for, meritocracy, that we should hire the best people for different jobs, and that the ESG and DEI movement were moving against that. But also, so could nepotism, that, there's other things that could also move away from just hiring the best person. And we wanted to say, how do we as a nation move towards, doing the best we can to have prosperity in our country, to maximize returns, and then say, hey, like as a company, our fiduciary duty is to maximize returns. And then as a nation, as a people, that the goal, that the rule of the people is actually to make the rules. So like, we're not just going to have like a 100% complete capitalist society with no rules. Like clearly, like as a nation, we want some rules, right? Those rules, if you think about the sports analogy, become the rules for which the company to maximize value within, right? So this comes down to things like, as an example, how do we think about immigration, right? Like that is the rules of the nation. That is a political question, right? And then once those rules are set, the companies then have a fiduciary duty to maximize value within the rules, right? And so we're not anti-rules, but what we were seeing was not that. We were actually seeing the reverse, where the companies were actually constricting themselves more than the rules for ESG purposes, for DEI purposes, basically hating growth for our nation, where it should be the reverse, and let the people speak for the rules, not corporate leaders.
I want to throw a curveball Bitcoin question. I think, you spend a lot of time, you do a lot of legwork talking to like the traditional investor, talking to like a lot of the suits, which is great. Thank you for your service. I'm obviously, you can see I'm wearing the hoodie. But I cover the world of like the Bitcoin technical discourse. That's obviously my focus. I over focus on this. Have you been paying attention at all to any of the Bitcoin technical discourse? You've been in it for a long time, so you're probably a little bit of more aware than the average, like fund manager about how Bitcoin works. But there's like soft fork discussions around covenants, filters, Bitcoin Core, OpCat. You're on the complete other side of Bitcoin. I'm curious if you have any thoughts or even awareness to these topics. Feel free to sidestep this question, but I'm kind of curious at your thoughts. I bet you don't get these questions very often.
So I would say, from the perspective of investor questions, I never get this question. From talking with the Bitcoin community, I definitely get this question, right? Like, and so I guess that's part of the interesting thing is, are you a suit or are you not a suit? I think that there's a spectrum. Basically, the only time I wear a suit is when I'm at a conference, and besides that, you'll never see me in a suit. But
if you're a 2016 Bitcoiner, yeah, that's I would say that's OG status. You've been around a long time. You get to wear a little bit of a cypherpunk feather in your cap.
Yeah, so. Yeah, a little bit, right? I like to rock the hoodies, but yeah. I dress in the costume when I have to, right? But we did before I go to your question, we did raise our entire pipe without anybody wearing a suit one time, 100% on Zoom calls.
Nice.
We got a comment one time that said, "Oh, you're underdressed," and I was like, "No, we're going to raise this thing without a suit."
You're overdressed. Yeah.
Yeah, exactly. But did rock the golf shirt. So I guess with regards to how we think about soft forks, the security of Bitcoin, what Bitcoin is, I'm of the mindset of moving very slowly with regards to any type of change away from what Bitcoin is. The base case answer to me is always, don't change things if it's not broken. But that would be, to be open-minded to, if more of a consensus of the technical experts across the people that are smarter in that than I will ever be, because I'm extremely good at math. I'm not a coder. I mean, I could get around in Excel pretty well. I could do some VBA, some basic coding, but that's just not what I'm great at. And so, I think that moving very slowly and very intentionally, if a change was ever made, is probably the right way to go, and to be very biased against change. That would be my personal bias, and to really let the OG community have more of a consensus to have conviction and change. And if we don't see that, then I would say no change. So that's the high level of how we view it. We do want to be supporters of Bitcoin as, the infrastructure of Bitcoin, the push to make, the United States very Bitcoin friendly. So, we're, consistently talking with groups like the Bitcoin Policy Institute, who, we're very close with, to say, how do we, push a thriving Bitcoin ecosystem over the long run, solve problems, that we actually can be more helpful in solving. So I'll give you an example of one that I think Strive is more likely to be helpful in. And it's around Bitcoin being money. And so we would likely agree that Bitcoin makes for perfect money, like structurally, but there's a massive problem. And that massive problem is capital gains. That Bitcoin, even if it structurally is perfect money, it doesn't function as money. It's capital gains money, right? Like every time you pay a coffee, you have to either break the law or you have to report a taxable transaction. Like that's your two options, right? Those are horrible options. And so how do we push over the long run a system that actually gives people choice of currency without capital gains? That's ultimately, in my view, the most likely thing that a Bitcoin treasury company will be uniquely helpful in, because it's going to be a long-term educational process with DC. It's likely going to require a lot of actually like monetary investment, not just time investment, but monetary investment in DC. And I don't just mean to like pay politicians off. I just mean like the game is played in the sense that you get access through donations, and donations does not mean that they will take your point of view, actually. Like if your point of view they just structurally disagree with, they won't, but like it gets you in the arena to actually have the serious conversation, right? And so we as an industry have to be taken serious. We have to present this well, and we have some ideas, not to discuss really today, but some ideas of how we might think about making that change over the course of the next, call it, I wish it was the next year, but probably the next decade or so, and move things in that direction. Because if you had the ability to use your Bitcoin without paying taxes, then you would likely potentially spend your Bitcoin. Like people are always like, why don't you spend your Bitcoin? It's like, well, because one, I believe Bitcoin's going to go up substantially higher. Two, I don't want to report a taxable transaction every time I buy a cup of coffee. That just doesn't make sense. I would love for Bitcoin to, through the United States, actually be money. I think it would actually be one of the best ways that we could think about building a strategic Bitcoin reserve. It could strengthen the United States for decades and centuries to come. So that's a place where I would say you be more likely to see us be a leader versus, I would say, a skeptical, move slow, talk to people follower, because I just don't think that's going to be an area where you're going to see a company that's great at finance be the leader of a movement.
It makes sense. We can attack it. We can do a pincer maneuver. The technical devs will talk about making Bitcoin better money at the consensus level, and the companies will figure out how to advocate for Bitcoin in the real world. So, Matt, I really appreciate you coming on the show. Appreciate the insights. Last question. What are you excited for in 2026? What are you looking forward to?
I'm very excited to see some new liquidity come into the system. I think we're at a place where monetary conditions are tightening, and we know that as they start printing money, that what that does for Bitcoin over the long term. And look, I mean, I would wish that we would be fiscally responsible, but we know that's not the case. And so our bags are packed for what we know is going to happen. And I think we're at the precipice of, pretty substantial liquidity working into the system, and likely in 2026. And so that is from a structural perspective for Bitcoin, what I'm most excited about.
All right, you heard it. Thanks so much for coming to the podcast. I'll see you in person someday at one of these Bitcoin conferences, and I'll come shake your hand.
Thank you.